In this fourth video, we're going to be discussing a different kind of dividends, what is known as a stock dividend. A stock dividend is a distribution of additional shares of the company's stock to its stockholders. We're going to see that it doesn't change assets, liabilities, or equity because essentially you're just transferring an amount out of retained earnings and into paid-in capital. So why do companies pay stock dividends? Sometimes a company's stock price will get so high that a lot of investors are not going to purchase stock at that price. So they want to bring the stock price down so that it will be more affordable, more actively traded, which is a better thing for the corporation. So we're going to see that with a stock dividend, because additional shares are issued, supply and demand means that the market price of the stock should come down some. A stock dividend can also be something that management offers to show their confidence in the firm if they don't want to distribute a cash dividend because they want to reinvest the cash in the business. So like cash dividends, there are three important dates for stock dividends. Two of them are the same, the declaration date and the record date, but the final date is referred to as the distribution date for a stock dividend because we're not paying out cash, we're distributing shares of stock. So the accounting for a stock dividend depends on whether it's a small stock dividend or a large stock dividend. A small stock dividend means that it's going to be a distribution of 25% or less of the outstanding shares. So when we're accounting for a small stock dividend, we're going to use the market value of the shares to be distributed, and retained earnings is capitalized at the market value of the shares on the declaration date. And what we mean by that is that the amount that we're going to move out of retained earnings and into paid-in capital is going to be the market value of the shares issued. On the other hand, a large stock dividend is when the company's board of directors declares a stock dividend of 25% or more of the outstanding shares. When we have a large stock dividend, we're going to account for it using the par value of the shares. So in other words, we're going to take, instead of using the market value times the number of shares to be issued, we're going to use the par value of the shares to be issued. And that's the amount that we're going to transfer out of retained earnings and into paid-in capital. So we're going back to our Georgios example, and we're going to say that for 2023, Georgios earned net income of $159,700, from which those $4,000 in cash dividends were paid that we looked at in the last video. So with that in mind, at December 31, 2023, we can put together a stockholders' equity section for Georgios Company. The balance in their common stock account is $800. The balance in additional paid-in capital is $39,300, and retained earnings is going to be $155,700, which is a beginning retained earnings balance of 0 plus net income of $159,700 minus the $4,000 in cash dividends. So our total stockholders' equity at the end of 2023 is $195,800. We have $800 in our common stock account, and that is a 10% par for our 8,000 shares that are outstanding. So on January 2024, when the market price of its stock was $32 per share, Georgios declared a 20% stock dividend to shareholders of record on February 1 to be distributed on February 13th. So we've got a declaration date of January 20, we got a record date of February 1, and we've got a distribution date of February 13. So the first thing we need to figure out is how many additional shares will be issued. If we have 8,000 shares currently outstanding, we multiply that times 20% to get 1,600, and that's how many additional shares will be distributed in this stock dividend. So is this a large stock dividend or a small stock dividend? It is a small stock dividend because it is less than 25%. And we need to figure out what is the amount of retained earnings to be capitalized. We're going to take the $1,600 shares we're going to be issuing, multiplying that times $32 per share, and the total amount of retained earnings to be capitalized is $51.2. So essentially, we're going to be decreasing retained earnings by $51.2 and increasing, ultimately, our common stock and additional paid-in capital accounts by that amount. So on the declaration date, January 1 of 2024, we're going to go ahead and decrease retained earnings for the total $51.2, which is the market value of the shares to be distributed. So we're debiting retained earnings for that amount. We're not issuing the common stock yet, so we don't want to credit common stock. So in the meantime, we're going to credit an account called Common Stock Dividend Distributable. This is not a liability account. It doesn't meet the definition for a liability. It's an equity account that is going to be credited for the par value of the shares until they're issued. So what goes into Common Stock Dividend Distributable is the par value of the shares that we're going to be issuing, or 1,600 shares times 10 cents each, $160. And then the difference between the market value and the par, once again, is going to increase additional paid-in capital. So we're going to be crediting additional paid-in capital in excess of par for our common stock. 51,200 minus 160 is 51,040. So our record date, February 1 of 2024, is going to determine which of our shareholders are going to receive the additional shares of stock. And then on the distribution date, we're going to distribute the stock. When you distribute the stock, you can credit the common stock account for the par value of the shares you're distributing. And we're going to take that dividend distributable account off our books by debiting that account. So let's take a look at the effect of the stock dividend on our stockholders' equity accounts. So prior to the dividend, common stock had a balance of $800. Additional paid-in capital in excess of par had a credit balance of $39.3, and our retained earnings account had a balance of $155,700. Those numbers are going to tie back to that stockholders' equity section we looked at earlier in this presentation. So with the stock dividend, we are increasing common stock by $160. We're increasing additional paid-in capital by $51.40. If we add those two together, we get $51.2, and that is the amount by which we are decreasing our retained earnings account. So if we take a look at our stockholders' equity section before and after the stock dividend, we see that the total doesn't change. In both cases, we have total stockholders' equity of $195,800. We've just moved an amount out of retained earnings and into paid-in capital. So stock dividends don't decrease assets or equity, they just change the composition of your equity.